December 2001, where you're a 43-year-old accountant named Maria, living in Buenos Aires with a Renault Megane purchased on credit 18 months ago, and a university degree and a life insurance policy, paid into for 11 years, and a vacation property outside Mendoza, bought in 1998. You have a closet full of nice things including electronics and a home theater system bought on installments representing all the ordinary furniture of a middle-class life you worked hard to build. On December 1st, the Argentine government freezes all bank accounts in what is called the Corralito, where you cannot withdraw more than 250 pesos per week, and within days, the peso loses 70% of its value while 5 presidents cycle through in 11 days. You stand in your apartment surrounded by everything you own, and slowly you begin to understand something no one ever explained. Almost everything you spent money on became functionally worthless, including not damaged and not stolen, but useless in the new reality you now inhabit. This pattern played out in Weimar Germany and the Soviet Union, and Greece and Venezuela and Zimbabwe and Lebanon, where it repeats with mechanical precision and always destroys the same class of people, the ones who followed the rules and bought what they were told to buy. Before we continue though, understanding how economic collapse renders a middle-class purchases worthless through systemic dislocation rather than physical destruction diverges sharply from mainstream narratives that diversify consumer assets provide security. Real financial resilience requires studying these collapse patterns, so subscribe to the channel so you never get caught off guard by financial crises. Most people have a cinematic idea of collapse, where they imagine empty streets and burning cars and soldiers on corners, but most of the time collapse is quieter where it's administrative and bureaucratic. The stores are still open, but prices change every week, and the banks still exist, but won't give you your money while your house is still standing. But no one will buy it, and your car still runs, but fuel costs more than your daily wage. Collapse doesn't mean everything stops, but means the relationship between money and reality breaks where the price signals that organize your entire life become noise. And when price signals become noise, the purchases you made based on those signals become stranded. They sit there physically intact, but economically dead, and that is the mechanism, not destruction, but dislocation. Purchase 1. Real estate bought at wrong cycle timing becomes unpayable prison. The first purchase that collapses, render useless reliably, is real estate purchased at the wrong point in the cycle. And this is the one people resist most because the mythology around real estate is the deepest financial belief held by the modern middle class. Land is real and they aren't making more of it, and property always goes up, but these are beliefs and not natural law. Japan 1991, where after extraordinary asset inflation, Japanese real estate prices peaked at hallucinatory levels, and ordinary families took out 100-year mortgages representing multi-generational debt contracts to buy modest apartments. They were told prices only go up, and that Japan was different, but prices fell and kept falling for over 3 decades, where Japanese residential real estate lost 70 to 80% of peak value in some areas. An entire generation had purchased homes that imprisoned them where they couldn't sell because they owed more than the property was worth, and couldn't move because the mortgage followed them and couldn't rent the property out for enough to cover payments. The home, their greatest asset, became their greatest liability. United States 2008, where between 2003 and 2006 American households took on $4.5 trillion in mortgage debt, and home values doubled in 3 to 4 years in cities like Las Vegas and Phoenix, but then prices fell 40 to 60%, and roughly 10 million Americans lost their homes to foreclosure between 2007 and 2014. That's a population larger than most European countries. But an outright economic collapse of real estate becomes truly useless, where in Greece after 2010 property values in Athens fell 42%. But the real problem was liquidity, because there were no buyers, and the market froze. Properties sat unsold for years, while the Greek government, desperate for revenue, raised property taxes dramatically where homeowners were trapped, paying rising taxes on an asset they couldn't sell in a currency they couldn't control in an economy contracting by 6% a year. In Argentina, Maria's vacation home lost 60% of its dollar-denominated value by 2003, where she couldn't sell it, because no one was buying recreational property during a national emergency. but she still had to pay maintenance and taxes. The asset became a cost center, representing a hole she poured money into hoping the market would return, and for many Argentines it never did. The mechanism is real estate doesn't become useless because the building falls down, but because the financial architecture around it collapses, where mortgages become unpayable, when incomes crash, and properties become unsellable, when credit freezes and taxes become unbearable, when governments become desperate. Purchase 2. New automobiles on credit become immobile metal anchors. The second purchase is the automobile, specifically the new automobile purchase on credit. And this is more devastating because the car is the asset. The broadest number of middle-class households are most leveraged into at any given time. Venezuela 2012, where Venezuelans were buying cars at record rates with auto loans common, and a new car was a status symbol and functional necessity. But by 2016, the economy had contracted by more than 30%, where inflation ran above 800% annually. The automobile had become one of the most useless objects in the country, not because people didn't want to drive, but because the entire ecosystem that makes a car functional had disintegrated. Fuel, despite Venezuela sitting atop the world's largest oil reserves, became scarce due to refinery collapse, while spare parts became unavailable because imports dried up, and tires became a luxury item where a set of 4 new tires cost more than most people earned in a year. Insurance became meaningless because insurers couldn't pay claims in a currency worth less every day, while roads deteriorated as infrastructure spending collapsed. Tens of thousands of relatively new cars sat in driveways physically intact and mechanically sound, and completely useless where you couldn't drive them because fuel was unavailable, and couldn't repair them because parts didn't exist, and couldn't sell them because no one had money. And you certainly couldn't keep making loan payments when your salary had been obliterated by hyperinflation, where the loan didn't collapse with the economy, but the debt remained while utility vanished. That gap between what you owe and what you can use is where a middle-class destruction lives. Purchase 3. Life insurance and pensions become worthless paper promises. The third purchase is one people consider the very definition of prudence, including life insurance and pensions and retirement accounts, representing long-term financial products sold on the promise they will protect you in the future. This is the cruelest autopsy because these are purchases made by the most responsible people who planned ahead and sacrificed present consumption for future security. And in collapse after collapse, they lose the most precisely because they trusted the system most deeply. Weimar Germany, where before World War I, Germany had one of the most developed insurance and pension systems in Europe, but the hyperinflation of 1921 to 1923 destroyed it completely. A life insurance policy that would have paid out enough to buy a house in 1914 was by November 1923 worth less than a loaf of bread, including not metaphorically but literally, where a policy worth 20,000 marks was paid out in currency that couldn't buy a newspaper. The saver was made whole on paper and destroyed in reality. Argentina 2008, where the government nationalized approximately $30 billion in private pension funds, and workers who had diligently contributed to what they believed were private protected accounts discovered. Their retirement savings were neither private nor protected, where the money was gone, absorbed into general government spending. Lebanon 2019, where the banking system effectively confiscated deposits, and people who had saved in US dollar-denominated accounts discovered they could not access their funds, where banks imposed informal capital controls and dollar withdrawals were forced through at artificial exchange rates representing a 70 to 90% haircut. Life savings disappeared where the mechanism is long-term financial products or promises, but the money they promise is denominated in a currency that may not hold value, and managed by institutions that may not remain solvent and regulated by governments that may change the rules. Every one of those assumptions is exactly what an economic collapse destroys. Purchase 4. University degrees become keys for locks that no longer exist. The fourth purchase is the university degree where knowledge itself is never useless, but a degree is not the same thing as knowledge. A degree is a credential representing a signal sent to an employment market, and that signal has value only if the employment market it's aimed at still exists. Soviet Union, where when it dissolved in 1991, the command economy that gave credentials their value dissolved with it, and millions of highly educated Soviet citizens found themselves holding credentials that no longer mapped onto any functioning labor market. Engineers drove taxis, and physicists sold goods at open-air markets, and university professors earned less than street vendors, where it was not that their education had made them stupid, but that the system their education was designed to serve no longer existed. The degree was a key and the lock had been changed. Greece after 2010, where youth unemployment reached 60%, and between 2010 and 2015, an estimated 200,000 young educated Greeks emigrated, taking their degrees purchased at great expense by families who believed education was the path to security. Greece paid the cost of their education, while other countries received the benefit, where the mechanism is a university degree is an investment in a specific economic structure that assumes the industries that exist when you enroll will still exist when you graduate. In a collapsing economy, every single one of those assumptions fails simultaneously. Purchase 5. Consumer goods on credit become depreciating anchors. The fifth purchase is the broad category of consumer lifestyle goods purchased on credit, including home theater systems and designer furniture and electronics, representing the accumulated material weight of a life built on the assumption that income would continue and credit would remain available. Zimbabwe between 2007 and 2008, whereas hyperinflation accelerated towards 79 billion% per month. People rushed to buy anything, because holding Zimbabwe dollars for even a day meant losing purchasing power. But the electronics broke, and there were no parts to repair them because imports ceased, and the appliances failed, and there were no technicians, because they fled the country where the goods were consumed, and when they were gone with no residual value. People who had spent their last stable currency savings on consumer goods found themselves with houses full of depreciating objects and no liquid resources where they had traded flexibility for stuff. In Lebanon after 2019, when the currency peg broke and the lira lost over 90% of its value. Consumer debts remained where credit card bills still arrived and installment payments were still due, but the income to service them had been gutted. The goods that the debt had purchased sat there depreciating and unsellable in a market where no one was buying, where in a stable economy, buying goods feels like building a life, but in a collapsing economy, goods are weight. They are anchors that tie you to a place you might need to leave, and consume maintenance resources you might need for survival, and represent spent capital that can never be recovered. The pattern. 5 pillars of middle-class identity fail first and most completely. Real estate and automobiles and financial products and education credentials and consumer goods represent the 5 pillars of middle-class identity in virtually every modern consumer economy, where they are what you're told to buy and what you're told represents success and stability. And in every economic collapse across every continent, they are the 5 categories that fail first and most completely. And this is not a coincidence, but structural. The middle class is, by definition, the class most integrated into the formal economy, where the wealthy have diversified assets often held internationally, while the poor have little to lose and are already operating in informal economies. But the middle class is fully invested, where their wealth is in their home, which is mortgaged, and their mobility is in their car, which is financed, and their security is in their pension, which is institutionally managed, and their future is in their degree, which is leveraged to a specific labor market. Every single thread that holds the middle-class life together runs through the formal financial system, and when that system breaks, every thread snaps simultaneously. This is why collapses don't destroy the rich who were never fully dependent on the system, and don't destroy the poor who were never fully included, but collapses destroy the middle class specifically and mechanically and almost surgically. The cruelest part is the purchases that destroy them are the purchases they were most encouraged to make, where every one of those purchases was in reality a bet that the currency would hold, and that institutions would remain solvent, and that the labor market would persist, and that the government would honor its commitments. In stable times, those bets pay off for decades, but then the system breaks and the bets are called. Since 1900, there have been at least 68 sovereign debt crises, and 58 currency crises, and scores of banking system collapses affecting countries across every continent, where the average citizen has roughly a 1 in 3 chance of living through at least one major financial crisis in their adult lifetime. Weimar Germany was the most culturally advanced nation in Europe, while Argentina was one of the 10 wealthiest countries in 1913, and Lebanon was called the Switzerland of the Middle East, while Venezuela had the largest proven oil reserves on Earth. Greece was a member of the European Union backed by the European Central Bank, and none of it mattered when the math broke, and the purchases that people made trusting in that math broke with it. This is not saying don't buy a house, and not saying don't get an education, and not saying don't save for retirement. We're in a functioning economy. These are often reasonable decisions. But understand what you're actually buying, where every long-term financial commitment is a bet on systemic stability, and systemic stability is not guaranteed. When you buy a home with a 30-year mortgage, you are betting the currency will hold, and the labor market will support your income, and the property market will remain liquid, and the government won't change the tax structure, representing 4 separate bets. None of these are bad bets in isolation, but stacked together they create enormous concentrated exposure to a single risk factor: systemic stability. And that is a risk most people never consciously evaluate because the system itself tells them it doesn't exist. It is now 2003 where Maria still has her apartment, though it is worth half what she paid, and she still has her car, though she can barely afford to run it. And her life insurance policy payout bought 2 weeks of groceries. Her vacation home sits empty, accumulating tax liens while her degree hangs on the wall, and she is working but not as an accountant, earning a third of what she made before in a currency that buys a fraction of what it once did. She's learned something she will never unlearn now, where every purchase she was told was smart and stable turned out to be a bet placed on a system that failed. The system wasn't designed to betray her, but was designed in a way that made betrayal inevitable under certain conditions, and those conditions arrived. The question is never whether those conditions will arrive somewhere again where the historical record answers that clearly, because they always arrive somewhere eventually, and the question is whether you will recognize the pattern before you are inside it or only after. Thanks for watching. Here's what I want knowing from you though. If economic collapses have rendered middle-class purchases worthless with mathematical precision across 68 sovereign debt crises and 58 currency crises since 1900, creating a 1 in 3 lifetime chance of experiencing systemic failure, does this prove that traditional middle-class wealth-building strategies represent concentrated bets on systemic stability that most people never consciously evaluate, or does it ignore that these purchases still represent optimal choices within functioning economies, where the real risk is under-participation in wealth building rather than overexposure to systemic collapse? That distinction determines whether the lesson is to fundamentally restructure how you build security by maintaining liquidity and optionality and avoiding concentration, or whether it's to accept that participating in modern economies requires accepting systemic exposure as unavoidable cost of building any wealth at all. So drop your take in the comments, because I genuinely want hearing whether you think the historical pattern justifies radical defensiveness in asset allocation, or whether it represents hindsight bias that would cause more harm through missed opportunities than protection through avoided catastrophes.